Greg, let's talk about some of the moving parts that are contributing to the latest market volatility.
Yeah, and this is really all about central banks more than anything else. And really, we came into this market year thinking that, well, the Fed was going to change its tone. We knew the central banks and governments had been incredibly accommodative in the past 2 years since the pandemic. And they really did change their tone in January. And it doesn't seem to be the end of this either, as we expect volatility to be around with us for the next few quarters, at least, as everyone's trying to put a stamp down on inflation and the Feds are trying to rush to normalize policy.
You've brought in a few very key points. Inflation. At first, the conversation seemed to be around transitory inflation, and now it seems the conversation has shifted, and it seems that we're in this period of sustained inflation. And of course, as you had mentioned, central bankers using interest rates as a tool to mitigate those risks. How are markets ultimately going to respond? Is this a period of adjustment? Is this a correction? What is a market correction?
Well, I think it's a combination of all of the above. I think one of the biggest things we've got going on right now, though, is a sector rotation. It got too easy to be an investor a few years ago. You could just buy the big cap tech stocks, have some government bonds with longer duration, and that was a pretty nice portfolio. But that's all really changed, as you want to be really focused on shorter duration assets. So you don't want government bonds because they don't work in times of rising yields. And you wanted to adjust out of that away from the long duration assets like tech, which work when interest rates are really low and their multiples expand, but they don't work when things start going the other way. So we've definitely got a bear market and a correction in these tech stocks, which really were the ones that benefited from the low interest rate environment. And as interest rates have gone up so fast in the last little bit, we've seen this massive sector rotation away towards the cyclicals. So it's a tale of different markets right now, because it's definitely a correction in the NASDAQ, but less so when you look at the cyclicals and in energy in particular. So Canada's actually not in a bad spot right now and should outperform as long as this environment persists, but there's definitely some pain in other parts of the market.
As you have mentioned, let's talk about tech. We've seen this, I guess, decade-long dominance of the technology sector. What do you attribute that drop to? You had suggested interest rates. Is that the full story?
Well, I think it's a combination. The interest rates was the catalyst. That was the pin to get the sector to drop. And I think it's also, you can break away between the large cap techs and the speculative techs, these unprofitable tech, which is kind of systemic by the ARC names and some of these other SaaS names, which were more companies that were built on prospects of saving problems 10 years out. And those places, in those companies, there are still maybe some great ones that come out of this, but they don't really work in a period of rising interest rates. And that's why we're seeing a lot of differentiation here. What we might start to see as this turbulence continues is that people start to go back to some of those ultra large cap tech stocks, because when you look at the Microsofts, the Googles, the Apples, these are companies that are not trading at super high multiples. And they also have incredibly strong balance sheets. So they could almost become the new defensives. But in the first blush, we got a big correction in the market and then everyone sold everything. Now the next stage is going to be separating the winners from the losers, and it's going to happen within every sector.
You had talked about at the beginning that this period, how long are we going to see this market adjustment, is somewhat unknown. But as we see the Fed take on this more hawkish tone, and of course the Bank of Canada following suit, can we expect this for the rest of the year? And what do you anticipate 2023 to look like?
Well, it feels like it's going to be more of the same as we start to continue to watch central banks work on normalizing interest rates. And that's a statement that they've been throwing around for a while, but we haven't really had central banks normalize interest rates since the global financial crisis. So it's a big act for them to try and hit this objective, and we'll see if they can actually do it. But really, inflation is going to be the big thing right now. Everyone's going to be watching these CPI readings in Canada and the US and see if we can finally get them to crack down. Everyone did think that this was a transitory event that was really triggered by the supply chain disruptions that came out of the pandemic and the lockdowns. But it's now bled into more of a commodity event, as we're not seeing a lot of commodities being produced in both Europe and with some sanctions in Russia. And also Canada is really not ramping up a lot of production either. So it doesn't seem like there's any quick fix to the commodity inflation. So there's going to be a tough act for the Feds to follow to get rid of inflation. And I think it could be with us for a while.
I haven't heard you use the word recession. Is that on your radar?
It's really hard to say a recession in North America when we're looking at these unemployment rates. Certainly, you could get a technical recession because the balance of trade and other parts of the GDP calculation might trigger into a negative. But this is really the big dichotomy that I think a lot of investors have right now, is that in their personal lives, things are feeling pretty good. It seems like everyone that wants a job has a job. There's wage inflation, so people are getting paid a little more than they were before. But the problem is the price of the pump's higher, the grocery bill's higher, and really what's going on is the stock market's not any higher. So it's really been a big disconnect between the real world and the financial world. So we might get a recession, but really, even without that, the stock market's kind of starting to price it in already. The one thing that we might be getting instead of a recession is more of a financial crisis. These type of events tend to occur in times of distress. And when you get big moves like we've seen in either the NASDAQ or the bond market or different commodities, funds tend to blow up. And I think that's right now. And you never really know until it's already happened in the headline, but that's something to watch the next few months.
What is the investment strategy then going forward? What sectors do you see opportunities in? What's catching your eye?
Well, again, you want to stay away from long duration assets. So within fixed income, you want to stay shorter duration, more active credit strategies. Commodities are going to do really well in this environment in times of inflation. We're already seeing that with oil over $100. So oil and these energy stocks on any dip look like something you want to buy, because these sectors are going to return a lot of capital back to shareholders. And then I think you also want to just stay away from some of these sectors that had led in the past, because as much as there might be a bear market rally in some of these areas and there might be a bounce, it's not often out of one of these that the sector that led before leads you out. So it's going to be some sector rotation. So it's going to be a volatile period. Active management should be passive in this environment. You want to stay shorter duration and you want to watch the commodities.
We haven't even gotten into the geopolitical landscape, and I'm wondering whether or not emerging markets are something that you're looking at this point.
The emerging markets aren't really on our radar screen yet. It's going to be a tricky environment because China's still basically in a lockdown. And as we're hearing more and more comments that their vaccines aren't working, that could really put a dent on the Asian growth prospects for the next year or two until they actually get that figured out. So emerging markets normally work in this type of environment because they do act better with commodities, but it doesn't seem like it's going to work in this cycle.